Good day, students. Once again, we'll be doing the last video on chapter 16, the chapter that focuses on standard costing, where we are calculating variances. So now I will be doing question 16.6, and I will be doing all the required variance in this exercise. And I want to bring to your attention that I did another video on 16.5, which I went in details in terms of the variance formulas or standard costing formulas that are used to calculate variances. So in this video, I will not go in details in terms of the formulas, but I will just be applying the formulas. However, maybe here and there I might a reference to the formula sheet, and please make sure that you first watch the video in 16.5 before you watch 16.6. Unless you are already familiar with the chapter, then that will not be a problem. So now 16.6 standard costing doing variance says that the Latuma company manufactures desks. The standard costs are used in evaluating actual performance. The standard cost of producing one desk under normal circumstances and capacity is known as shown below. So now we are given our standard cost information, or our budgeted information. In other words, this can be said as budgeted information. Then now under our standard cost of producing one desk, we have direct material, which is 25 meters at 2 rand 50 cents. That means the standard meters of material per unit is 25 meters, which is the standard meters of material per unit. And the standard price of material per meter is 2 rand 50 cents, which is 2 rand 50 cents per meter. Let me just say per meter so that we are very clear that it is per meters. So now that will be 2 rand 50 cents per meter. Then now if we say the standard material meters per unit times that by 2 rand 50 cents per meter, that will give us 62 rand 50 cents, and I may call that cost per unit. So now that will be the cost of material to complete 1 unit of a desk. Then, and take into account the fact that when we do standard costing, or when we do variance, we deal with the units with the cost per meter, not the cost per unit. We will be using the cost price, which is 2 rand 50 cents per meter, not the 62 rand that is provided to us per unit. Then now it further says that our direct labor is 1.5 hours at 12 rand per hour. Therefore now that means the standard labor hours per unit is 1.5. And when I say standard labor hours, I'm referring to the number of hours that it takes to complete 1 unit, which is standard labor hours per unit is 1.5. That means it takes 1.5 hours to complete 1 unit. And employees are paid 12 rand per hour. Employees are paid 12 rand per hour. So now if you say 12 rand times by the labor hours it takes to complete 1 unit, that will give us 18 rand, which is the cost per unit. But the cost per unit will not be used in the calculation on when we do our variances. We take the labor rate, which is labor rate of 12 rand per hour. Then we are given the variable manufacturing overheads as 1.5 hours per unit. So now that means it takes 1.5 hours to complete 1 unit in terms of the variable manufacturing overheads. So now that means the standard overhead, or the standard variable overhead hours per unit is 1.5 hours. And our variable overhead are incurred at standard, which is 5 rand per labor hour. And remember, once again, as I did made emphasis on the previous video, that variable manufacturing overheads and fixed manufacturing overheads are normally or are based on direct labor hours. So now that is why you see that the labor hours under the direct labor, which is 1.5 labor hours, is the same as the standard variable overhead hours, which is 1.5, and together with the fixed manufacturing overhead hours, standard hours per unit, which is 1.5 hours, because our overheads, fixed and variable, they are based on the direct labor hours. That means the base that is used to allocate the overheads, which is fixed and variable, we are using the direct labor hours. So now we proceed with that. Then the 1.5 variable overhead hours per unit is 5, and if you say 5 times that by is 1.5, if you say 1.5 times that by 5, it will give us the variable overhead, which is cost per unit of 7 Rand 50 cents. And as I said to you that we don't use the 750 to calculate our variance or to do our variance, but we only use the 5 Rand, which is per labor hour. Then the next overhead on standard information or budgeted information is the fixed manufacturing overheads. And our fixed manufacturing overheads, we have 1.5 standard hours, which is standard hours per unit. And that standard hours is incurred at 10 Rand per labor hour. That means our fixed overhead rate per labor hour is 10 Rand. And we normally call this predetermined overhead rate in other terms. And in abbreviation, we normally say that is POR, where the base is labor hours, which in this case is 1.5 labor hours per unit. Therefore, now that will give us 15 Rand per unit. But as I emphasized to you that once again, that we don't make use of the cost per unit when we do our variance. They just provide us with this information, sometimes just to test if do you know what to use and what not to use. So now that was standard information, or that was budgeted information. Then now they say below that the actual, take note, they say the actual, therefore now that means the information below here is the actual information. The actual cost of operations to produce 200 units. So now this is actual production, because it says the actual cost to produce 200 units. So now this will be completed production or actual production. This will be actual production. That means units that are completed. Actual production. To complete 200 desks during the month of January is given to us below. So now we are given our direct material that was purchased. Therefore now the company bought 5,300 meters of material. And these meters of material, they were bought at 2 Rand 80 cents, which is the actual cost of material per meter. And I want to emphasize on that. The 80 cents is per meter. The 80 cents is per meter. Take note of that. Although they don't specify, but it is per meter. That's why if you say 2 Rand 80 cents, times that by 5,300, therefore now this will give us the total material cost that was incurred to buy the 5.3 meters of material. So now we can do the comparison at this point in time, where we say that there was a standard material which was previously, there we had our standard material price per meter, and our standard material price per meter was 2 Rand 50 cents, which was based on the budgeted information. But now when we see now when the company went to buy material was no longer as they estimated, or was no longer as it used to be on standard or budget. Now they realized that the material cost per meter was 2 Rand 80 cents. So now that means obviously the price, which is the actual price, it is higher than the standard price. That means now if the standard price is lower than the actual price, then the difference of 30 cents would be a variance. Therefore now we can see that when it comes to the material standard price and the actual price, there was a variance, which is per meter, or which is cost per meter. Then now remember the 5,300 is the quantities of material that were purchased, which is 5.3 meters. Remember, we'll also need to use this when we are doing the material variance. Then now we go to the next one, which is direct material issued. So now the company, after they bought the 5,300 meters of material, they only made use or make use of 5.3. Therefore now the 5.3 is the material that was used in production, because we only make use of the material when we send it to production, so that it get to be converted into becoming a finished product. So now we have material 5.3 that was purchased, and we have material 5.1 that was used. Therefore now 5.1 meters will be the material used. And all this becomes very important when we do our variance, because we need to split between the material purchase and the one that was used. So now, as I said to you, that material issued to production, that means we made use of the material by converting that into the desk that this company manufactures. Then now we go to the direct labor, and our direct labor, we are given 320 hours. That means this is the actual hours, the hour that the company incur in order to manufacture the 200 desks. So now employees or the direct labor, they took 320 hours, and those 320 hours and those employees were paid 11 rand. These employees were paid 11 rand. So now this is the actual rate that was paid to employees. Then now we need to go and we compare if is this rate higher or less than what we anticipated, or what we had on budget, on standard. So now the actual rate that employees were paid per hour, and let me say per hour, although they don't specify, but know that this is per hour. This is per hour. So now employees were actually paid 11 rand per hour. Therefore now we have to compare this 11 rand with the standard rate of labor per hour, and our standard rate of labor per hour was previously at 12 rand per labor hour. So now the company budgeted that they will pay their employees 12 rand per hour, but they actually paid them 11 rand per hour. So now obviously this variance will be very favorable, because the company is paying actual cost, which is less than the standard cost or the budgeted cost. Then now the total is already provided to us, which is 3,520 rands. So now we are already provided with that. Therefore now we can go to the next entry, which says that variable manufacturing overheads. And before we just move further, I want to bring this to your attention. We are given the direct labor hours, which is 320, and as I said to you, that this is actual labor hours, because it is under the actual information. This is the 320 hours that we actually incur in order to manufacture the 200 desk. But now we did not see any budgeted hours when it comes to the standard table. When it comes to this table, we did not see any budgeted hours, so that we can compare the budgeted hours with the actual hours. But as we proceed, maybe we'll see some information. We did not see any budgeted total hours. We're only given the standard hours per unit, not the standard hours in total or budgeted hours in total. It was only 1.5 per hour and 1.5 per hour. Or 1.5 hours, in fact, which is 1.5 hours it takes to complete one unit. So now we did not know how much the total budgeted hours, but only the 1.5 hours per unit, which is the number of hours it takes to complete one unit. So now let us then proceed once again. We are then provided then with the next part, which is our variable overhead. Our variable overhead, they are given to us in total as 2,380 rands. And now we have to calculate, in this case, the actual variable overhead cost per labor hour, because I said to you that our variable overhead are based on labor hours. Therefore now we need to determine how much the actual variable overhead cost per labor hour. That means we just take the amount which is actual cost, we divide this by the total actual labor hours, and our total actual labor hours, there we have it is 320. This is the number of hours it took to complete the 200 units. Therefore, now we can say 2,380 rands, and we divide this by 320. Then after, this will give us 7 rand. This will give us 7 rand 44 cents. It gives us 7 rand 44 cents. Just recalculate it, 2,380. We divide this by the total labor hours, which is total actual labor hours, and that was 320. Therefore, now that means our variable overhead will be, it could be written as 320 hours at 7 rand 44 cents. So now this will be our variable overhead actual rate per labor hour. Actual variable rate per labor hour, 7 rand 44 cents. It was not provided to us, but we had to make use of the knowledge that we have, and we calculate that rate, which is actual overhead, variable overhead rate per labor hour. So now that will be 7 rand 44 cents per labor hour. Remember, I said to you that we don't use the total in variance. We only use that when we do the fixed expenditure overhead variance. Then we have fixed manufacturing overhead, and our fixed manufacturing overheads, it is actual given to us as 2,900 rands. So now that 2,900 rand, we can also calculate once again the fixed overhead rate per direct labor hour, where we say the actual fixed cost divided by the actual labor hours. And the reason we divide that by the actual labor hours is the fact that our overhead, as I did emphasize to you, that our overhead are based on labor hours. Therefore, now hence we divide the actual cost of 2.9 by the actual labor hours to get to the fixed overhead rate per labor hour. Therefore, now we say 2,900, we divide this by 320, and this will give us a total of 9 rand 6 cents. 9 rand 6 cents. So now that means our actual fixed overhead per labor hour will be 9 rand 6 cents. So now we can also write this and say 320 hours, which is the same labor hours, because as I said to you that overheads are based on labor hours. 320 at 9 rand 6 cents. So now that will be the information that we have just extended, which was not provided to us. But as I said to you that it is very crucial to know how to analyze the given information, how to convert the totals into becoming per hour or per hour or per meter. So now we have done that comparison. Let us then now do the last comparison for the fixed overhead. And our fixed overhead, actual, we can see that our actual fixed overhead per labor hour is 9 rand 6 cents. And the per unit standard, which was our standard fixed overhead per labor hour, it was 10 rand previously. There we had 10 rand previously. So now we can obviously see that there is a variance. Previously we had budgeted fixed overhead per labor hour as 10 rand, but now we can see that it is no longer the 10 rand that we estimated. Therefore now that means we have in this case obviously saved. Therefore now this variance will be favorable, because the standard rate of fixed overhead, or the standard rate, yes, of fixed overhead is not the same as the actual rate, but in this case our actual rate is lower than the standard rate. So now that will be, or that will lead to a favorable variance. Then now we continue with that same note. We go then to the next information that is given to us. Then now we are told that the flexible budget for this department at the monthly level used to set budgeted, take note of that, used to set the budgeted fixed overhead rate called for 675 direct labor hours. So now this is the budgeted labor hours that we have, that were used to set the budgeted fixed overhead. So now they are telling us that these are the 675 direct budgeted labor hours. Therefore now this is budgeted labor hours. They gave us at last budgeted labor hours. So now if they give us budgeted labor hours, it means we can make use of the budgeted labor hours to calculate what we call budgeted production, because in this case we are only given budgeted labor hours, but we don't know our budgeted production. Because if we do have budgeted labor hours, remember these labor hours, they were based on the number of units that the company budgeted to produce. Because before we produce, we first have to have budgeted units, budgeted also labor hours, and labor hours and also material. Then now in this case, we are provided only with the budgeted labor hours, which was used to set the budgeted fixed overhead. So now we can calculate in this case our budgeted production. Then let us calculate our budgeted production. With the budgeted hours, remember budgeted hours is normally an abbreviation that says BH. Then our budgeted hours is equal to budgeted production equals budgeted production times that by standard labor hours per unit, times that by standard labor hours per unit, standard labor hours per unit, labor hours per unit. That is how do we get to our budgeted hours. Let me just show you the formula where all this information is coming from. As I said to you that please make a reference of the formula sheet that I've explained in the previous video. So now this is under the fixed overhead variance. This is the formula sheet that I explained in the previous video, which start with the material for the standard costing variance. But I just want to bring your attention only to the variance that will lead us to get to our budgeted production. To get to budgeted hours, this is BH, meaning budgeted labor hours. They say equals budgeted production times that by standard labor hours per unit. Remember, standard labor hours per unit is the number of hours it takes to complete 1 unit of the product. And we know that our standard labor hours is 1.5 per hour, which is the number of hours it takes to complete 1 unit. It's 1.5 hours. Not per hour, 1.5 hours. And we are looking for the budgeted production. So now in this case, we have to substitute our budgeted hours, because our budgeted hours is 675. So now that means the formula can be simply written like this. Budgeted labor hours is equal to budgeted production times that by 1.5. And remember, we do have budgeted hours. It is given to us as 675 already. We are looking for the budgeted production. Budgeted production. Times this by 1.5 hours of labor. So now, because we are looking for the budgeted production, or yes, the budgeted units for production, therefore now we have to divide this by 1.5. When we say divide this by 1.5, this cancel this. Then we divide here by 1.5. Therefore now we do our calculations and we say 675 divided by 1.5. This will give us 450. Therefore now 450 units is equal to budgeted units. 450 is equal to budgeted units. 450 is equal to budgeted production. Budgeted production. Budgeted production. So now we do have our budgeted production, which is 450 units. 450 units is our budgeted production. So now we do have almost everything that we need for the calculation of the necessary variance. So now we do have our budgeted production, and we also do have our budgeted labor hours. Then now from here we can proceed further to the next level of the question, where we then now have to calculate the variance that are given to us. So now that means our budgeted production is given to us or is calculated as 450. Let us just write it here, and we say 450, so that we do have it somewhere. 450 budgeted production. I just want to write it to make sure that it is somewhere in my workings. Budgeted production. Budgeted production. Our budgeted production is 450 units. 450 units. So now we do have everything in our workings. Then now the next part is to go to what is required, or to the requirements. They say calculate the following variances: direct material issue price variance, and direct material quantity variance. Then after, direct labor rate variance and direct labor efficiency variance. Then after, we do variable overhead expenditure or spending variance. Then we do variable overhead efficiency variance. Then after, we do the fixed overhead volume variance. The fixed overhead volume variance. And they say not required for second year. So now they just tell us that for a reason that I don't know. Maybe it's really not required. So now let us do the variants that are provided to us. I'll try to cover all of these variances that are given to us. So now we go to the first one, which is our direct labor price or direct material price variance, which is direct material issue price variance. That will be number A. We are doing 16.6. Then we have A, which is direct material. Direct material. And that will be direct material issue price variance. And we know that this variance says that standard price minus actual price times this by actual quantity purchased, times this by actual quantity. And we have to be specific because there are two quantities. There is quantities that were used, but in this case is actual quantity purchased. It is specifically actual quantity purchased. Therefore now our standard price of material, it was 2 rand 50 cents. If I still remember, our standard price was 2 rand 50 cents, and our actual price was 2 rand 80 cents, and our actual production was 5,300 units. Let me just confirm all these figures. We have our standard price of material. Our standard price of material per meter was 2 rand 50 cents. And our actual price of material was 2 rand 80 cents. Under the actual column or actual table, there was material of 280 per meter. Therefore now this was material purchased, 5,300 meters of material. Remember, I mentioned to you that the material that was issued to production 5.1 will be the one that will be used. I said that will be material used. We'll use that in the next variance. Then we do calculate our variance, and our variance will be 2.50 minus 2.8. Then we multiply this by 5,300 meters, and this gives us 1,590, which is unfavorable variance. It will give us 1,590, which is unfavorable variance. This will be unfavorable variance. Then we do number B, and number B is the direct material efficiency variance or usage variance. Direct material usage variance, and our direct material usage variance will be the standard quantities minus actual quantities used. Standard quantity minus actual quantity used, termed that by the standard price. And remember that standard quantity is always, you'll normally have to calculate it. Our standard quantity, we know that it is actual production. Standard quantity equals actual production. It is actual production times that by standard meters per unit, times that by standard meters per unit. Standard meters, in this case we are using meters, standard meters per unit, and our standard meters per unit was given in the information provided to us. So now our actual production, we know that the company actually produced 200 units. Then we have to multiply that by the standard meters, and standard meters was 25. There was the standard meters per unit, 25 meters. That means the company needed 25 meters in order to complete 1 unit of a product. Then we multiply this by 25 meters. Therefore, now this will give us standard quantities. Therefore, now we say 200 times this by 25, and it gives us an amount of 5,000. And that is 5,000 as SQ, which is standard quantities. Therefore, now we can say 5,000 minus the actual quantities that were used. And actual quantities that were used is 5,100. Remember, I did mention to you that the quantities of material that were actually used was 5.1. There was direct material issued to production, 5,100. So now that is where that 5,100 is coming from. Then we times this by the standard price of material, and our standard price of material is 2 Rand 50 cents. It is 2 Rand 50 cents, which is the standard price of material. Therefore, now from here we can calculate our material usage variance. Minus 5,100, and we multiply this by 2 Rand 50 cents. And this will give us 2 Rand 50 cents as our variance. It will give us 250 as our unfavorable variance, and it will be 2 Rand 50, and that is unfavorable. That is unfavorable. Then now we go to the third variance. We go to the third variance, which is variance number C, and that is the direct labor variance. Then we do see, then we say direct labor rate variance, direct labor rate variance. And this direct labor rate variance, it is the standard rate minus the actual rate times this by the actual hours. And our standard rate of labor, it was 12 Rand. Our actual rate, it was 11 Rand, and our actual hours was 320. Let us just see all these figures. Our standard rate of material per hour was 12 Rand. That was the standard rate. Sorry, standard rate of direct labor. Standard rate of labor was 12 Rand per hour. And our actual rate of labor, there was direct labor, actual rate of labor per hour was 11 Rand. Then our actual labor hours was 320 actual labor hours. So now it's 12 minus 11 times that by 320. Then we will get to finally a favorable variance. Minus 12 minus 11 will give us 1, times that by 320, it will give us 320 as a favorable variance. Then that 320 will be favorable variance. Then after now we do our direct labor efficiency variance, which is variant number D, direct labor efficiency variance, where we are calculating the efficiency of the employees variance. Then now our direct labor efficiency variance is calculated by saying standard hours minus actual hours times this by the standard rate of labor. And as I said to you that standard quantity of material must be calculated similarly with the standard labor hours. So now our standard hours, which is for labor SH standard hours, it is the same as actual production, but we multiply this by the standard labor hours per unit. We multiply this by the standard labor hours per unit. We multiply by the standard labor hours per unit. We multiply this by standard labor hours per unit. And our labor hours per unit, they were given to us as, I think, 1.5. So now our actual production, we know that the company manufactured 200 units, and we multiply this by 1.5. Let us check if our actual production was really 200 units. Yes, our actual production was 200, where the company actually produced 200 units. And our standard labor hours per unit, it is 1.5. That means the number of hours it takes to complete 1 unit. So now we times this by 1.5, and this will give us standard hours. 200 times this by 1.5, this will give us 300 hours. Therefore, now our standard labor hours, it is 300 hours. Then now we can go and we substitute, and we know that our actual labor hours was 320. Remember, that was our actual labor hours. Then now we say standard hours is 300 minus actual hours 320, and we times this by the standard rate. And our standard rate of labor, it is 12 rand. Therefore, now this will give us once again an unfavorable variance. 300 minus 320, and we times this by 12 rand. Therefore, now it will give us 240 as an unfavorable variance. And as I did mention to you that it does not necessarily favorable variance. When the variance is negative, it does not mean that it is automatically an unfavorable variance. It depends to what did you start with. So now we go to the variable overhead expenditure or spending variance. We go to the variable overhead expenditure or spending variance, which is number E. We do variable overhead expenditure variant or spending variance. And this variance is very similar to the direct labor, which says standard rate minus actual rate, and times this by the actual hours. Our standard rate of overhead, let us check. I don't remember. Our standard rate of overhead, it was 5 rand. It was 5 rand per labor hour. There we had 5 rand. Variable overhead. The standard rate is 5 rand, and the actual rate we calculated. The actual rate was 7 rand. There was the actual rate. It was 7 rand. Let's change the color so that we see it properly. There we had our variable overhead rate, and our rate we calculated that as 7 rand 44 cents. So 5 rand minus 7.44 will give us an unfavorable variance. 5 rand minus 7.44 times this by the actual labor hours. Remember, actual labor hours is still the same 320 that we used when we did our labor hours. It does not change. Then now we have 5 rand minus 7.44 and we times this by 320, and this gives us 780.8. Rounding off, you can round off to the whole number. It will depend to the instruction in the exam, but I prefer 2 decimal. We have 780.80 cents. And also this variance is unfavorable. We paid more actual overhead than we expected or than we budgeted. Then we go to the variance before the last, which is variable overhead efficiency, variable overhead efficiency, variable overhead efficiency variance. Our variable overhead efficient variance will be very similar once again to the one of labor. Then we know that this variance, it is standard hours minus actual hours, times this by standard rate of overhead. And the standard hours does not change. It's the same standard hours that was there in the labor variance. That standard hours which we calculated to be 300, nothing changes. Standard hours is 300. Actual hours is the same 320, nothing changes. But now the standard rate of overhead, it will definitely be different. The standard rate of overhead is the 5 rand. There was the standard rate of variable overhead. It does not change, the same 5 rand which was budgeted. Therefore, now we get another, once again, unfavorable variance. 300 minus 320, and we term this by 5, and it gives us 100 rands, an unfavorable variance of 100 rand. Then this variance will be unfavorable. It is unfavorable variance. Then now we go to the last variance, which is number G, as it was required. We go to the last variance, which is number G, as it was required to us. And the last variance was the fixed overhead. It was the fixed overhead. Let me just confirm which of the variants they require us to do under the fixed overhead. They required us to do the fixed overhead volume variance, which they also make mention that that is not for second year. So now let us do the fixed overhead expenditure, then we do the volume after. Let us do the fixed overhead expenditure and deviate away from the requirements. Let us do the fixed overhead expenditure, because they tell us that that one is for not second year. So now we are changing the requirement. We don't do what is not asked, because they say fixed overhead volume variance, it is not required for second year. So now let us do the expenditure variant. And remember, let me just bring you to the formula sheet where I am taking all this variance. Under the fixed overhead, we have all this list of variances, but now they under the fixed overhead variance, we first have number 1 and number 2. And as I said to you previous, this is 2.1 and this is 2.2, because the sum of these two variants is for the fixed overhead volume variance. So now we can do the fixed overhead expenditure variance. Then after we do the fixed overhead volume variance, though it's not required because I did it in the previous video, which is standard hours minus budgeted hours times by the standard rate. So now let us do the fixed overhead expenditure variance, where we do the budgeted fixed overhead minus the actual fixed overhead. Budgeted fixed overhead minus the actual fixed overhead. So now we are doing, this was not required, fixed overhead expenditure, fixed overhead expenditure variance, fixed overhead expenditure variance, expenditure variance, expenditure variance, And this variance says budgeted fixed overhead. It is budgeted fixed overhead minus actual fixed overhead. Budgeted fixed overhead minus actual fixed overhead. Actual fixed overhead. I'm not sure if we do have this information, all of it or not. Actual fixed overhead. Now let us check if did we have our budgeted. If it's not there, no problem. Because this was not a requirement for this question. I'm just extending this to a higher level. So now we had our fixed overhead, as we can calculate it. Under our budgeted fixed overhead, we had fixed overhead that was given to us. Our fixed overhead, there we had fixed overhead which was 1.5 hours, and we had 10 rand per labor hour, and the total was 15 rand per unit. So now if you want, you can say 15 rand times by the number of units that were budgeted, because we budgeted to produce 450 units. So now we can multiply that by 450 and say 450 units times that by 15 rand, which is the budgeted fixed overhead per unit, and that will be 6,750. Or else we can use the budgeted fixed overhead per labor hour, where we say the 10 rand, this is per labor hour, therefore now we have to multiply the 10 rand by the budgeted labor hours, and the budgeted labor hours was 675. Remember, we had our budgeted hours as 675. So now we can multiply this by the fixed overhead rate per labor hour. Then we say 675 times by 10. 675 times by 10. Then this will give us 6,750, which is the same amount, 6,750. So now we can see that our budgeted production is, our budgeted fixed overhead is 6,750. Now let us do that budget, and we know that our actual fixed overhead cost amounted to 2,900 actual. So now there's too much variance here, we can see. Obviously, the company budgeted to manufacture, remember, the company budgeted to manufacture 450 units, but they actually manufactured how much? Only 200. So obviously, the variance will have to be quite huge in this instant. So now our budgeted fixed overhead, it is 6,750 as we calculated, minus actual fixed overhead, which is 2,900. Then we can see that the variance is very unfavorable. Minus 2,900 is very favorable, in fact, which is 3,850. 3,850. That will be a favorable variance. We incur less than what we anticipated. So now let me just extend this a little bit wider, where I do the fixed overhead volume variance. Fixed overhead volume variance, though they say it's not required for second year. Fixed overhead volume variance. Fixed overhead volume variance. And we know that it is standard hours minus budgeted hours times this by the standard rate of fixed overhead. And we have to look for all that information. Standard hours minus budgeted hours. I just have to confirm that I've done it right. Standard hours minus budgeted hours, term that by the standard rate. It is correct. Then we have our standard hours. Remember, standard hours do not change. Standard hours were 300 hours. Is the same hour that we have used when we did our direct labor. The same way to calculate standard hours. Remember, standard hours is actual production times that by the standard labor hours per unit. And we know that actual production was 200, and standard labor hours per unit is 1.5, which is the number of hours it takes to complete one unit is 1.5 hours. Therefore, to calculate the standard labor hours, we said previously 200 times that by 1.5. Times that by 1.5, and it gave us the 300. Budgeted hours was given to us as 675. Budgeted hours 675. Therefore, now 300 minus 675 times that by the rate minus 675. times that by the standard rate per labor hour. Don't forget our standard rate of fixed overhead. Here the fixed overhead, standard rate for fixed overhead, standard rate for fixed overhead, just to change the pen. The fixed overhead and the standard rate per labor hour was 10 rand. That was the standard rate of fixed overhead. Standard rate of fixed overhead per labor hour is 10 rand. So now the rate that you multiply with here will be 10 rand, and this is the last variance. 300 minus 675 is equal to 375. Times that by 10, we get to an unfavorable variance of 3,750. And this variance is honestly unfavorable. So now with that being said, I can say, guys, thank you. And I said previously in the beginning, please refer to a video on 16.5, because that video goes in details in terms of giving you the formula sheet and referencing all of that. Thank you. God bless you.